In this video, we will explore about the basics of profit and loss account. The profit and loss statement, often called the income statement, is a critical document that shows the financial performance of a firm for a specific period. In India, the format for this statement is strictly defined by Schedule III of the Companies Act 2013. Additionally, IndAS 1 mandates that companies must include a section called Other Comprehensive Income or OCI right below the net profit. However, there are exceptions. Sectors like banking, insurance, and utility companies do not follow this standard format. Instead, they follow specific formats prescribed by their own regulators. For our learning journey, we will use the consolidated profit and loss statement of Bharti Airtel Limited for the financial year 2019 as our primary case study. Now let us look at the common profit and loss account line items, specifically starting with revenue and other income. Revenue represents the amount a company earns by selling its goods and services. This is generally broken down into two components. First, there is income from core operations, which is the main business activity. Second, there is income incidental to core operations. Companies may choose to combine these or report them separately. Then we have other income. This represents non-operating income, such as income earned from investments or profit from the sale of assets. A key nuance to observe in our case study is that Bharti Airtel reports other income separately below the operating profit line, distinguishing it clearly from its main business revenue. Moving on to the other side of the ledger, let us look at expenses. We can break expenses down into three categories. First, we have universal line items that exist irrespective of the industry, such as employee cost, depreciation, and finance charges. Second, we have manufacturing specifics, which are standard for production companies. These include cost of raw materials, purchase of stock in trade, and changes in inventory of finished goods. Finally, we have the catch-all category called other expenses, which includes items not separately disclosed. It is important to note that in the Indian reporting context, expense reporting varies significantly from global standards. For instance, while raw materials have high disclosure requirements, other direct expenses often have low or no disclosure. This creates challenges for analysts when trying to calculate accurate gross profits. Let us dig deeper into the manufacturing expenses, specifically cost of raw materials and purchase of stock in trade. The cost of raw materials represents the amount of material actually consumed during the production process. To calculate this in a periodic inventory system, we use a simple formula. We take the purchases, add the opening stock, and then minus the closing stock. The result is your cost of raw materials. Then we have purchase of stock in trade. This refers to the amount spent on purchasing goods that are sold to customers without any additional processing. This is typically the primary expense head for companies in the retail sector. Next, we look at changes in inventory and employee cost. When a company produces goods, the production expenditure is retained in the inventory until those goods are actually sold or disposed of. The line item for changes in inventory represents the difference between the opening balance and the closing balance of work in progress and finished goods. On the other hand, employee cost covers the total expenditure incurred towards employees. This is not just salaries and wages. It also includes employee benefits, staff welfare expenditure, notional expenses for stock-based compensation, and the annual provision for retirement benefits. Now let us discuss how we account for the wear and tear of assets through depreciation and amortization. Depreciation is the process of allocating the one-time expense of a tangible asset like a car or a machine and recovering it during its useful life. Under IndAS 16, the method used must reflect the actual usage pattern. For example, a cab operator might depreciate a car based on the distance traveled, whereas a standard company might depreciate it simply based on the number of years. Amortization is the same concept but applied to intangible assets. It refers to the gradual write-off of assets like patents or copyrights over the period of their life. We also need to account for financial and miscellaneous costs. Finance cost refers to the expenditure incurred towards servicing debt. This includes interest payments, processing fees, and the amortization of expenses related to issuing securities. Then we have other expenses. This is an aggregation of expenses that are not independently large enough to warrant their own separate line item in the main statement. To find the details of this, you must look at the notes to accounts. We also have income from equity accounted entities. This represents the company's share of profit from entities that are accounted for under the equity method, such as joint ventures or associates. Sometimes companies face unusual events, which brings us to exceptional items and tax. Exceptional items are income or expenses that do not arise in the normal course of business. Examples include a loss from natural calamities or one-time regulatory charges. After all expenses and exceptional items, we calculate tax. The tax component includes three parts. First is current tax, which is the tax payable for the given year. Second is minimum alternate tax or MAT. Theoretically, MAT is a credit or asset for the future, but if utilization is doubtful, it is expensed immediately. Third is deferred tax. This arises from a timing mismatch between tax authorities and accounting standards. It has no immediate cash impact but aligns the books for future tax benefits or obligations. Once we have the net profit, we must determine who it belongs to. This leads us to profit allocated to non-controlling interest and earnings per share. In a consolidated statement, minority interest refers to the portion of profits of a subsidiary that belongs to shareholders other than the parent company. After adjusting for this, we calculate earnings per share or EPS. Basic EPS is calculated by dividing net profit by the weighted average number of shares. We also calculate diluted EPS. This is a what-if scenario. It assumes that all potential equity, such as warrants, employee stock options, and convertibles, are actually converted into shares. For loss-making companies, the basic and diluted EPS will be the same. As mandated by IndAS 1, we also have a section for other comprehensive income or OCI. These are income or expenses that are permitted to bypass the main profit and loss account. These primarily represent changes in value due to non-operating factors. This includes changes in revaluation surplus, gains or losses on defined benefit plans, gains or losses on the translation of foreign financial statements, and changes in the fair value of financial assets. It also includes gains or losses on derivative contracts used for hedging risk. Just like net profit, a part of OCI from subsidiaries must also be allocated to non-controlling interest. Now that we understand the components, let us look at how analysts view these numbers through key metrics from profit and loss account. Most standard companies report in a single step format. They simply take total income minus total expenses to arrive at profit before tax. However, analysts prefer a multi-step format to get deeper insights. We transform the data to calculate specific metrics like operating profit, EBITDA, EBIT, and profit before tax. In this analyst conversion, we typically use a positive sign for income and a negative sign for expenditures to keep the math clear. Two of the most critical metrics derived from this transformation are gross profit and EBITDA. Gross profit is defined as revenue minus the cost of goods sold. Its purpose is to show the surplus available to meet fixed expenses. However, remember the limitation in India we discussed earlier. Direct costs are often not separately disclosed, making gross profit calculation difficult. That is why we heavily rely on EBITDA, which stands for earnings before interest, tax, depreciation and amortization. We use it because it is not contaminated by the company's capital structure, meaning interest, or its infrastructure choices, meaning depreciation. This makes it the best metric for comparing firms across different sectors. We also calculate adjusted EBITDA to exclude investment or non-operating income to find the pure operational value. Moving further down the profitability ladder, we have earnings before interest and taxes, or EBIT. This is essentially the operating profit. To calculate it, we take EBITDA and subtract depreciation and amortization. EBIT measures the profits left for the recovery of capital. Crucially, it indicates the company's ability to meet its debt obligations. This number is a key input for calculating the interest coverage ratio and for determining the free cash flow of firms used in valuation models. Analysts also often calculate adjusted profit after tax. The purpose of this metric is to find the true recurring profit by eliminating the noise of exceptional items and their tax impacts. To do this, we start with net profit, add or subtract exceptional items, and then adjust for the tax impact on those items. This gives us the adjusted profit after tax. A major challenge here is the tax rate. Effective tax rates can be meaningless in abnormal years. For example, in financial year 2019, Bharti Airtel paid huge taxes despite reporting losses. In such cases, analysts must identify unique items and apply a relevant specific tax rate to get a logical number. Finally, we look at the statement of changes in shareholders' equity. This statement is mandated by IndAS 1. Its purpose is to show the impact of various transactions on the different components of shareholders' equity. Ideally, it tracks the flow of equity components like share capital, retained earnings, and other reserves. It shows the balance at the beginning of the year, adds or subtracts any changes during the year to arrive at the balance at the end. This provides a complete picture of how the owner's value has evolved over the period.